One of the most common questions we saw over the course of May was, what has just happened since late March and why? Well, the what is very straightforward. We've experienced a 9-month rally that has carried key indices such as the S&P 500 and NASDAQ to new all-time highs. The why did it happen? It's a bit more of a tough question, but I think I can describe a two-step process here that really nails what happened. So there are two dynamics that are at play here. The first is that the market, when the Iran conflict began to price in and began to recognize in price the disruptions that are going to occur due to the loss of oil exports and due to the loss of the other exports such as fertilizer, liquefied natural gas, helium, etc., that all flow through the Straits of Hormuz. So, during the course of February and early March, we did see the markets come down in price about 10% from top to bottom. Now, in price, that's a pretty normal correction, and we would expect over the course of any year to see 1 to 2 10% corrections. So that doesn't seem like it's pricing anything particularly severe or anything ongoing, but we also have to combine it with a second feature here. The other thing that was going on at the same time is that bottom-up earnings estimates from analysts were rising rapidly and had been doing so for some time. So we were walking into a situation where the stock market had dropped about 10%. And prior to earnings season, earnings estimates had risen 10%. And so when you combine those two things together, what you saw was about a 20% valuation drop of key market indices such as the S&P 500. Now, if you take a look at a slide here, we're going to show you that drop in valuation is approximately what happened in April of 2025 with the tariff disruption fears. So this was pricing a very, very severe potential outcome. And we don't want to understate the amount of valuation change that happened here. And again, we can put another slide up here. This just illustrates in more visually here the path of earnings expectations from analysts. So you can see that this is something that continued to rise throughout the year and into March. Now, by the time we get into late March, really what happened is the markets begin to recognize that the Iran conflict is going to reach a negotiated solution at some point in the relatively near future. Now, that hasn't occurred as of the date of filming today, but again, markets are looking forward out 9, 12, 18 months and saying the disruption that we're seeing is temporary. Therefore, I'm going to start paying more attention to earnings. And as we went through earnings season, it was very clear that those analyst estimates for a 10% increase in earnings were far too low, and that really the earnings growth rate was more like 17% if you look at FactSet data. So, the market's attention shifted from the winding down Iran conflict situation to a rising earnings situation, and naturally, markets went up. Now, the other way we can look at this is through a behavioral lens, right? Ultimately, we just have to think about it this way, is that, during the opening days of the Iran conflict, there were a lot of fears about what could happen, and that led investors to get too pessimistic. And then once they realized their worst fears weren't going to come true, then they reprice the markets higher to reflect really what is the most likely outcome. Now, this is not saying that things, new information wouldn't cause the markets to go up or down further. However, we just want to take a look at the dynamics of what happened here, because it's not a straightforward, situation where markets came down substantially. It was very clear, and then they bounced off a low. It was this two-step combination of rising earnings and falling price and rising earnings. So again, if you have questions on this, please reach out. Happy to discuss it further and in more detail if you wish. And we'll move on to our second question. Thank you.